Welcome back everyone, and in this video, we are going to go over my dividend growth portfolio that currently has a value of over $80,000. This is a diversified portfolio of stocks that all pay out a cash dividend to shareholders every quarter and continue to increase that payment each and every year. And I call this my financial freedom portfolio because I'm using it to build up a second stream of passive income so that one day I can retire and use my dividends to cover all of my living expenses. And in this video, we're going to go over all the stocks that I own, take a look at how much dividend income this portfolio produces, and go over its most recent performance. But before we do that, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and sell, and discussing any major market news or headlines. So please hit the like button, subscribe to the channel for daily videos, and we're going to jump right in to this most recent update on my dividend growth portfolio that currently has a value of $80,735. And so far, it has grown over 12%, and I'm up $9,000 in the green on share price appreciation. So right now, I own 25 different companies in this portfolio, and they all are diversified across many different sectors. What they all have in common is that they all pay out a dividend that grows each and every year. And now we're going to start off by taking a look at my portfolio spreadsheet. This is a very simple Google Sheets that you can view at any time using the link in my description that lists out all of the companies that I own, how many shares, and the gain or loss on each position. So you can see it lists out the company name. My largest holding is Apple. I own 101 shares of this company, and the current share price for one individual share is $131. The total market value on this position sits at more than $13,000, and overall on Apple stock, I am in the green $2,672 or a 25% gain. And following that on the right, I have all the dividend information for each of these companies as well. I have how much one share produces in dividend income per year. So one share of Apple pays me 82 cents per year in a form of a dividend, and the current yield on this company is at a very low 0.62%. Every single year, Apple pays me $82 in dividend income, and they make up 16.5% of the overall market value of this portfolio. So right now, my $13,000 Apple position is around 16.5% of the total $80,000 value of my entire portfolio. And you can see I also have a nice chart that shows the 52-week performance of each of these holdings. And overall, just by taking a quick glance, you can see that I'm only in the red on 2 of my stocks by a very small amount. Procter & Gamble, I'm in the red by 2.4%, and Broadcom, which is the most recent addition to this portfolio, I am in the red by 1.8%. But overall with this portfolio, I'm not focused on the share price appreciation too much. As the shares grow over time, that is just an added bonus, because what I'm planning to do is build up this diversified portfolio of stocks to allow me to achieve financial freedom through the passive dividend income that they produce. Right now, I am not chasing high yield. I don't like buying companies with a 5, 6, 7, 8% dividend yield because I don't need the income right now. What I do is buy blue chip dividend growth companies that I believe can continue to grow that dividend for decades in the future and continue to return capital to shareholders in that form. I don't need to chase yield up front. I'm here for the long term. And you can see all of the companies that I own, like Apple, Microsoft, Visa, and all the other companies from every sector are all long-term blue chip names that I have no plan on selling anytime soon. And I will be the first to admit that this type of investing is very boring. And I get it. My portfolio may not be exciting because I'm not chasing the next high-flying growth company. But personally, I'm okay with that because I sleep like a baby, liking all the holdings that I own, not worrying about any company going bankrupt over the next quarter. And as a whole, I know these companies are globally diversified, operate every single day, bringing in billions of dollars every single year, and will continue to return capital to me in the form of that dividend. So I sleep like a baby at night with this portfolio, very low stress for me, and that's how I like it, and that's why I choose to invest in these larger cap blue chip names rather than focusing a majority of my income and my capital into some higher risk companies with the potential to see higher reward. So I do understand I'm not going to see any triple digit fast growth from any of these holdings, but over the long term, I am very comfortable and I do believe they will perform very well. And one thing I want to share, if you're new to the channel, I do have a smaller portfolio that is only valued at $2,000 where I invest in SPACs and small cap high risk plays. I'll discuss this portfolio in more detail later on, but essentially I keep it separate from the main portfolio. It's only valued at $2,000, but it invests in all the companies that I choose not to invest in the main portfolio. These are the smaller cap companies, the SPACs, that have a ton of risk, but also have a ton of potential to do very well over the long term. I started this portfolio late in 2020. So far, it's been performing very well, in the green on every position and up around 26% overall. But if we jump back in to the main focus of this episode, which is the main dividend growth portfolio, now let's take a look at how much income it actually brings in every single year. And if we jump over to Simply Safe Dividends, you can see that every single year this portfolio provides $1,949 in annual dividend income. So without me having to work, clock in at any job, this portfolio or my money will provide me with over $1,900 per year in dividend income. And even if I never invest another dollar of my own capital into this portfolio, this amount is going to grow each and every year because I choose to invest in companies with a strong history of growing their payment to shareholders every single year as time goes on. And my overall portfolio has an average dividend growth rate of 7.2% per year. So I'm expecting this income to grow at over 7% each and every year down the road. And that's incredible. Most jobs where you work 9 to 5, 40 plus hours a week, you don't even get a raise every year. Or if you do, it may be an average of 2 to 3%. But my portfolio of my passive income is growing at more than 7% per year. And if we break down that income, you can see it is diversified over each month, and every quarter is different because companies pay out different dividends at different dates, and as time, companies raise their dividend at different points in time. And if we take a look over my next 30 days, February is the largest month for me. You can see I'm expecting $231 of dividends, and today on February 1st, I'm expecting $181 from 4 holdings. And every single week of this month, I will be collecting dividends from all of my companies. So I love this income. It's completely passive. And after I do the upfront work of getting the capital to purchase these shares, the money comes in and compounds over time each and every year. And the next thing that I want to share about my portfolio is the dividend safety. So of course, just by listening, you can understand that I'm slightly more of a conservative investor. And I like owning companies where their dividend payment is considered safe and likely to continue to be paid out for many years in the future. And if we take a look at my dividend income breakdown, you can see 11% is considered borderline safe and 89% is considered likely safe. So the 89% of my portfolio is either ranked safe or very safe from Simply Safe Dividends. And what this program does is give one score for every single dividend company, ranging from unsafe, very safe, borderline safe, and overall, you can get 1-digit score to understand the potential safety or risk of the dividend income. And right now, 11% of my dividend income is considered borderline safe, and that comes from AbbVie, Bank of America, and JP Morgan Chase. And I'll be very honest, I am not worried about a dividend cut or suspension from any of these names, especially the banks. So right now, the Fed has allowed the financial institutions to do share buybacks starting 2021. And JP Morgan, for example, has announced a $30 billion share buyback program over the next few years. So if this company, JPM, can afford to do $30 billion of share buybacks, they understand that their current dividend is sustainable, and I'm actually not worried about a dividend cut coming anytime soon from any of these 3 companies, although they are considered somewhat borderline. But if we take a look now at the safe companies, you can see a majority of my holdings, or 89% of my income, is considered safe, and a lot of these companies that I own have the highest rating possible of 99 and are considered very safe. You can see I own a majority companies in that very safe range, and that is, like I said, allows me to sleep very well at night because I know this income is at a very low risk of getting cut or brought down anytime soon. And if we jump back to the portfolio overview, like I said, this portfolio is not anything fun, not super exciting, but I believe it can provide consistent income, grow that income each and every year, and will allow me to sleep like a baby, and I can just watch it grow passively as time goes on. And now I'm going to show you how the portfolio performed throughout January of 2021. So if we take a look, the portfolio started this year at just over $79,000. And throughout this month, I received $101 of dividend income and contributed $2,500 in my own capital into this portfolio. And I use this $2,500 to buy Broadcom and more shares of Apple. So you can see I did contribute a large sum of money into this portfolio over this past month. But if we take a look at the share price performance, it has actually dropped by $1,120 over the month of January. And I was actually in the green when planning for this video, but the last 2 days of the month, we saw a ton of red. And for example, the last day of January, the last trading day for the month, we saw the portfolio drop more than 2% or lose $1,750 of share price value. So that single day drop at the end of it really put the portfolio in the red with regard to share price performance. But overall, the portfolio ended the month with the value of $80,735. So we are still up in the month, but of course that really has to do with the massive contributions I'm doing every single month. And as a whole, I plan to contribute $2,500 of capital every month in this portfolio throughout 2021. So those consistent contributions are going to allow me to buy more companies, which will provide me with more dividend income. And of course, that's how the snowballing effect takes place. And over the next 5, 10, 15 years, I will really see the effect of compound interest kick in and the capital will grow at an exponential rate, allowing me to fully retire off this portfolio I'm expecting in the next 20 to 30 years. And now that I've really updated you on all the key information of how the portfolio performed over the past month, we saw the $100 of dividends I received, we saw the contributions I made, the decline in share price over the last few days really impacted the total month's performance, and I showed you how much income I'm receiving every year from this portfolio as a whole. And next, I'm going to show you my diversification of the income and the value of my overall financial freedom portfolio. So if we take a look back at the spreadsheet, the tech sector makes up around 39% of the total value of this portfolio, and the second largest sector is consumer staples, followed by financials, communication, healthcare, utilities, and a small position in industrials, which is made up of only one company. So of course, I am heavily weighted in the tech sector. Close to 40% of the portfolio value is within that sector. So I am a believer in diversification, and you can see after the tech sector, a lot of other sectors of the market are somewhat equally weighted in this portfolio, making up the remaining 60%. But one thing I also believe in is buying solid companies that you truly believe and understand, and you believe will continue to grow over the long term. And that's why I'm actually so heavily weighted in tech. My largest two holdings are Apple and Microsoft, and they make up around 28% of the overall portfolio. So I have to admit that is a ton of capital allocated to only two individual companies, but as a whole, I love their businesses, and I don't see any other companies knocking them out of their market leader position anytime soon. Both brands are globally diversified, they bring in a ton of revenue and income every year, these companies are cash cow machines, and I believe over the long term, there's not going to be many companies that can compete with them at such a large scale. They both have hundreds of billions of dollars of cash on the balance sheet, beautiful ratios overall on the income statement and balance sheet, and have massive cash flows that I'm not too worried about being overweight in those names. I don't think you can actually ever be too overweight into the strongest companies in the world. So that's why I'm a little bit overweight in tech as a whole if you're comparing this to a traditional valuation of sector diversification, but I am very comfortable with it. I have no plans to sell out or reduce that sector, and my newest position was actually Broadcom, which is technically a tech company from the semiconductor industry. So I do still add to this portfolio and the tech sector because overall, I just like buying strong companies. I try to diversify as much as I can, but if I like a company, I believe it's going to do well long term, I'm not going to not buy them just because it's going to throw out my diversification of the overall portfolio. So I hope that was clear. I hope you understand my thought process regarding what companies I buy and if I really care too much or if I'm very nitpicky on the weighting of each sector, because in reality, I'm not too focused on that, and I'm not worried if tech reaches 40-45% of the overall value. I still like the companies that I own. I think I am diversified enough across various sectors, and I own the leaders in every sector that I own. So you can see I own companies in the tech sector like Apple, Microsoft, Visa, MasterCard, and Broadcom. In the financials, I own the four largest banks, the two largest banks in America are JP Morgan Chase and Bank of America, and I also own the two largest Canadian banks, which are Toronto Dominion and Royal Bank. I also own some communication leaders such as AT&T and Verizon. In the healthcare sector, I got AbbVie, Johnson & Johnson, Merck, and Pfizer. And from the consumers, I have Home Depot and Lowe's, Costco, Pepsi, and some staples, I have Procter & Gamble, Kimberly-Clark. From utility/energy, we have Duke, Southern Company, NextEra, and the one single industrial company that I own is Canadian National Railway, which I love as a core holding. And one thing I want to share is that Bill Gates is actually one of the largest shareholders in this company as well. So now that was a quick little overview of this portfolio and an update for the month of January 2021. So this portfolio, I plan to do updates at the end of every single month because people are really highly requesting getting updates on all my moves, anything I buy or sell, and overall how this portfolio is performing. And people are really interested in the income that it produces, so that's why I like to share it very clearly on the spreadsheet that you can see from the link in my description. It shows it right down here, over $1,900 of dividend income, and you can see I also go over how Simply Safe Dividends predicts it as well. So thank you for watching, everyone. I am the Gen Z Investor. Every single day we talk about the stock market. I post daily videos. Throughout the week we talk about any major market news, and I always go over different stocks you can buy from various different industries or categories every single week as well. So thank you for watching and see you in the next episode.